All right, let's dive right into this explainer. Today, we are putting on our detective hats and jumping into some real-world financial forensics. You know, it's absolutely wild how a single, seemingly minor reporting choice can trigger a massive $67 million compliance red flag. Seriously, $67 million. So let's get into it.
Okay, so take a look at our primary evidence here. What we've got is an actual excerpt from a company's statement of cash flows, specifically looking at their investing activities. Now, at first glance, it looks like a perfectly normal corporate spreadsheet. You've got your purchases of property, proceeds from sales, some dividend income, the usual stuff. But hiding right there in plain sight is a critical accounting anomaly. It's exactly the kind of discrepancy that forensic auditors literally live to uncover. Let's break down exactly what went wrong.
If we zoom in just a bit, boom, we hit this massive negative figure. Right there on the second line, we're looking at an outflow of nearly $67 million. But look closely at the description tied to that massive hit. It says, stock converted into investment in property. Basically, the company is claiming that simply reclassifying nearly $67 million of their existing inventory as investment property somehow resulted in a cash outflow. I mean, that is a staggering amount of money to suddenly drop onto a ledger, especially when you pause and really think about what that line item is actually describing.
Which brings us to a crucial, really fundamental investigative question. When a company takes a building it was holding as inventory and decides, hey, let's rent it out instead, does any physical cash actually leave their bank account? Like, did they pay themselves in briefcases full of money just to change a label on a spreadsheet?
Well, of course not. This is what we call a purely non-cash transaction. The total value of the company's assets hasn't changed by a single cent, only the categorization has. And yet, despite that, this company dropped a $67 million deduction right into their cash flow statement, almost as if actual liquidity had drained from their accounts. It's essentially like treating an internal filing cabinet update as a massive corporate purchase.
Now, to really understand the severity of this, we just have to consult the rulebook. Specifically, we're looking at paragraph 43 of the IND AS 7 standard. This is the standard that governs the statement of cash flows. And let me tell you, it is zero tolerance on this kind of thing. It explicitly states that investing and financing transactions that do not require the use of cash or cash equivalents shall be excluded from a statement of cash flows.
So if we break that rule down, it dictates two totally non-negotiable steps. Step 1, you have to exclude paper-only transfers completely from the cash flow statement. This is absolutely crucial to protect the integrity of your liquidity tracking. And Step 2, don't hide it. You still need to disclose the transaction elsewhere in the financial statements. The goal here is to be transparent, for sure, but without muddying the waters of your actual cash tracking. You've got to keep the real, physical capital completely separate from your internal accounting maneuvers.
And wow, the contradiction here is just glaring. The company actively embedded a $66.9 million non-cash conversion directly into their cash flows from investing activities. Meanwhile, as we just saw, the IND AS 7 standard explicitly mandates the exact opposite: exclude it from cash flows and disclose it elsewhere. They basically treated an internal accounting reclassification as a hard cash expenditure. They're essentially blending fiction right in with their financial reality. So what's the bottom line here? Well, by dumping a non-cash transaction into their investing activities, the company clearly failed to comply with established reporting standards. And look, this isn't just some formatting quirk, it fundamentally distorts their actual cash position. Think about it. An analyst just glancing at that line might genuinely believe $67 million in actual capital was deployed, but that simply never happened. The verdict is pretty obvious. This is clear-cut non-compliance with IND AS 7.
The big takeaway for us is that we can literally never take numbers at face value without interrogating the accounting principles behind them. This whole case leaves us with a really vital, lingering question. If an error of this magnitude, nearly $67 million misclassified, can just hide in plain sight on a primary financial document, what other financial illusions might be lurking in the ledgers? It's a great reminder. Always, always follow the actual cash.